You're listening to AI Prism from Seoul Economic Daily.
Japan's 10-year government bond yield just hit a 30-year high, and this is not only a Japan story. New 10-year paper touched 2.930%, the highest since September 1996. Britain's 10-year gilt reached 5.04%, the only major developed market above 5. Korea's national debt sits at 50.6% of GDP, low by peer standards, but the semiconductor tax windfall funding, it is not guaranteed. And Korea's $200 billion investment package for the United States is now entangled with tariff risk. Short pause. It's Tuesday, August 18th. Here's why global investors are paying attention to Korea today. Sovereign bond markets in Japan, the United States, and Britain are repricing fiscal risk at the same time. Japan's government debt exceeds 260% of GDP, which limits how far the Bank of Japan can lift rates without straining interest costs. That constraint keeps the dollar-yen gap wide and pushes pressure outward to every other Asian bond and currency market, including Korea's. Here's what the numbers show. 2.930%, that was Japan's 10-year yield at its session peak on Monday, a 30-year high driven by expectations of a September hike. The 2-year yield rose 4 basis points to 1.690%, the highest since May 1995. Japan's second quarter GDP grew 1.1% annualized, missing the 2% consensus and complicating the tightening case. Matter-of-fact, former ADB President Takehiko Nakao argued a policy rate of 2.25 or 2.5% would not be unreasonable, against today's 1.0%. The U.S. Treasury's $25 billion 30-year auction cleared at 5.216%, the highest in 25 years. Korea's national debt reached 1,412.8 trillion won, about $1.01 trillion at 1,401 to the dollar, or 50.6% of GDP. Mandatory spending is projected to climb from 370.9 trillion won to 465.7 trillion won by 2029, roughly $265 to $333 billion, growing 5.9% a year. Washington already imposed a 12.5% tariff under a Section 301 forced labor finding, and an overcapacity tariff above 2.5% would push the total past the agreed 15% ceiling. So what does this mean for global investors weighing Korea exposure? Earlier, we said Korea's fiscal position looks comfortable at 50.6% of GDP. Here's what that actually means for you. The comfort is cyclical, resting on semiconductor corporate tax that lifted next year's revenue forecast above 500 trillion won, about $357 billion. If that cycle turns while global term premiums stay elevated, Korean duration and the won reprice together, and the tariff timeline is the nearer catalyst. Watch the Bank of Japan's September policy meeting for the pace signal Governor Ueda has flagged. Watch the first project announcement in Korea's U.S. investment package, still guided for late August or early September. Watch Washington's overcapacity Section 301 decision and whether the combined tariff rate holds at 15%. That's today's AI Prism Global Investors. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a WAN-IFRA award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.